What if trading a single company's stock could be considered illegal, just because of confidential news about a completely different firm? This is the controversial legal theory behind what regulators now call shadow trading. In 2016, Medivation executive Matthew Panuwat received an email about his company's impending acquisition. Instead of buying Medivation stock, he bought call options on Insight, a biotech firm with no direct business ties to Medivation. When the deal broke, Insight's stock surged and Panuwat pocketed over $100,000. The SEC charged him with insider trading, arguing that the confidential information about Medivation was legally connected to Insight. But here's the catch. To enforce this, regulators first have to prove those connections actually exist. And they can only do that after the stock price moves. That creates a massive enforcement puzzle. The SEC can't just guess which companies are economically linked. To catch shadow trading, they'd theoretically have to scan the entire US market, looking for suspicious trades across thousands of unrelated tickers. To make that possible, they're leaning heavily on the Consolidated Audit Trail, a centralized database that records virtually every trade in real time. Critics point out that this turns routine market data into a form of digital surveillance, raising serious questions about privacy, overreach, and whether the legal standard itself is even predictable. You can't be held liable for breaking a rule that's impossible to define in advance. So a team of researchers asked a sharp question. Can modern AI actually do what regulators assume insiders already know? Could a language model read public SEC filings and reliably map which companies are economically linked before any news breaks? They built a two-stage natural language processing pipeline to analyze management reports and 10K filings from over 30 major corporate acquisitions across 5 industries. First, they used fine-tuned sentence transformers to convert each company's public disclosures into high-dimensional vector embeddings. These embeddings capture semantic nuance around supply chain dependencies, risk factor overlap, and competitive positioning, far beyond simple keyword matching. The model then calculated pairwise cosine similarity to rank which companies were textually closest to the target firm. Next, they tracked the stock market reaction on the announcement day, calculating abnormal returns using a standard market model to isolate the specific price movement from broader market noise and sector beta. Finally, they computed a shadow signal score by correlating the similarity rankings with the abnormal returns. If shadow trading is a real, predictable phenomenon, you'd expect a strong monotonic relationship. Higher textual similarity should consistently predict stronger abnormal returns. The results are fascinating, but they don't tell a simple story. In Panuwat's specific case, the model correctly flagged Insight as a close textual match, which aligns with what we already know happened. And in some cases, the pattern held remarkably well. Take the Goodyear and Cooper tire merger. The model ranked 9 peer companies by disclosure similarity. 8 of those 9 saw positive abnormal returns on announcement day. The highest-ranked peer posted the strongest reaction, and the trend was consistent across the group. A similar signal showed up in the Warner and Ramai acquisition, where the top 2 most similar companies both posted some of the largest gains in the entire dataset. In these scenarios, the language model didn't just guess. It successfully mapped the exact economic linkages the market was quietly pricing in. But real markets are messy. Across the full sample of 30 events, the overall correlation between textual similarity and stock reaction fell statistically indistinguishable from zero. In nearly half the cases, the market behaved in the exact opposite direction. In the Tenneco and Federal Mogul case, the top 3 peers gave mixed signals, and lower-ranked companies actually dragged the average reaction downward. Then you have cases where macro forces completely drown out the signal. When BB&T and SunTrust announced their merger, every regional bank peer rallied. But the gains had almost nothing to do with textual similarity. The least similar companies actually outperformed the most similar ones, because the market was simply pricing in regulatory approval for broader bank consolidation. The AI captured the text, but not the regime change in the sector. So what does this actually mean for financial regulation and market structure? If public documents can't reliably predict economic linkages, then the legal standard for shadow trading becomes fundamentally fuzzy. You cannot be expected to follow a rule that isn't empirically predictable. This finding doesn't just challenge a new enforcement theory. It puts direct pressure on the surveillance infrastructure the SEC is building to catch these trades. The research shows that while transformer-based language models can process financial disclosures at incredible speed and scale, they cannot reliably reveal hidden market connections that the law assumes are obvious. The gap between what the legal system presumes and what the data actually shows is where the real debate lies. For quants, compliance officers, and market monitors, this isn't about replacing human analysis with a black box. It's about adding a rigorous, data-driven lens to an area that's historically relied on intuition and post-hoc pattern matching. By combining NLP-driven similarity metrics with traditional cross-asset correlation models, we can start to spot economic linkages that were previously too buried to track systematically. And in a market where information arbitrage moves at the speed of fiber, that kind of transparency might be exactly what we need to keep the playing field fair. If you want to dive into the actual paper, the methodology, and the full dataset, I've linked everything in the description. Let me know in the comments how you think regulators should handle the gray zone between legitimate information arbitrage and insider trading. Thanks for watching, and I'll see you in the next one.